Emerging market currencies, particularly in Latin America, have been losing as the dollar rallied this year. Downward pressure has come in multiple forms, weakening macroeconomic growth in each country, plus the prospects of a U.S. interest rate hike are just two of them. Now, here to share insight on projections for Latin American bonds in 2016, Daniel Morris, Senior Investment Strategist for BNP Paribas Investment Partners. Now, long-term investors have been bearish and sort of added to heightened investor interest in Latin America, as we've seen. But if they delay macro growth and undermine a currency rebound, tell me, which countries are really going to be hit the hardest?
Well, I think you've got to look at fundamentally their exposures either to the wider macroeconomic environment or their own perhaps internal issues. So on the wider macroeconomic front, as you mentioned, you certainly have interest rates rising in the US. You have worries about China growth and therefore China demand for other emerging markets. And then related to that, of course, is the price of oil, which for oil exporting countries is negative, but then the flip side is that's positive for oil importing countries. Besides all of that, which is already challenging enough, you have a lot of domestic issues, Brazil probably being the key example on perhaps the more negative end of the spectrum, not necessarily implementing the policies that are required, whereas Mexico might be an exemplar on the other end where they really are pursuing the policies that are necessary. So even with a challenging macroeconomic environment, there are still a lot of levers that the countries themselves have to try to manage the situation.
Let's talk about Moody's projections, sort of very much in line with what you're saying. Moody's says, in general, Mexico, Chile, and Peru are better positioned to face the global headwinds because of their modestly improving economies. And in Argentina, the credit environment remains negative. We expect business and investor confidence to remain an important factor across the region. Tell me, do you think this analysis goes far enough in terms of those factors to really watch out for if you are looking to invest or just sort of keep an eye on the markets?
Absolutely. Foreign sentiment is very important to these countries, and I guess fundamentally one of the weaknesses of a lot of the Latin American countries versus other emerging markets is their dependence on foreign funding for either their trade deficits or their budget deficits, so that requires them to be conscious of what foreign investors think. Clearly, we've had a lot of redemptions from retail investors into emerging market debt over the last 6 months to a year. So far, and I think this is encouraging, you really haven't seen that from the institutional investor base. So they see the longer term value in emerging market debt really may not be adding at this point, but at least they aren't pulling out.
Are they really the ones who you want to watch out for in terms of a quick change as the market sort of shift?
Well, it would be a very negative signal if you did suddenly start to see institutional investors pulling out of the market. But so far we don't see that. I think what foreign investors are going to be looking for, besides again evaluating the macro environment, China, the US and so on, is whether the domestic policies are either staying in place, the good ones, or if they're not good, that they're going in the right direction. Again, Brazil probably being the key example here.
Very interesting. Daniel, let's talk about sort of phases. Shobin Morden, head of Latin American strategy at investment bank Jefferies & Co. in New York, says, what we need to stabilize the currencies is growth in the region and after growth, a tightening cycle, but the earliest we can get it is probably sometime next year. Do you think this analysis goes far enough?
Well, it definitely presents the dilemma that these emerging economies face when you have interest rates rising in the US. I mean, fundamentally, higher US interest rates tends to pull money out of emerging markets. That's going to weaken the currencies. Countries that already have budget or trade deficits are therefore more vulnerable. To offset that, most of the time, the central banks need to raise interest rates to re-attract capital, but then, of course, that's negative for growth. So if you have a country that's already in a fairly unstable macroeconomic budget situation, you add this dynamic of rising interest rates, either domestically or abroad, it becomes quite challenging. So as a foreign investor, I think that's how you need to differentiate between those countries that are more or less attractive, or if they're a market that is challenging, what are you being paid for taking that risk?
Let's look at the worst case example, and that's what Brazil's economic plight currently, right? Moody's says it's really hovering around that junk status. So looking forward at those global headwinds, what could Brazil lose in the years to come?
Well, already been downgraded to junk status by S&P. Who knows what Moody's is going to do. Certainly a comment on the policies that you've seen in the government over the last year or so. I think, again, from an investor's perspective, there's risk and there's rewards. You have quite high yields in Brazil right now. You've had a huge devaluation of the currency. So we are perhaps getting to a point that I think you actually will see increased investor interest in Brazil, depending very crucially on the attitude that the market takes towards managing its own domestic economy.
In the case of Argentina, are hedge funds the only ones who can sort of ride the wave until it achieves some sort of stability on the bond market front?
I would say it's not solely hedge funds. I think you can see other institutional investors that are participating in a selective basis, for funds where this level of risk-taking is appropriate within their mandate. So no, I think it is more broad and certainly could broaden further if we do see more positive signs out of Argentina.
We saw Mexico go from the 90s, where it was hemorrhaging, to now essentially being the standard bearer. Do you think that Argentina, Brazil will be able to pull themselves out of the precarious situation they're in?
Well, it's fundamentally political will. I think it's clear what they need to do, at least from our perspective. Again, the measures that Mexico took: central bank independence, free floating currency, fiscal rectitude. It's all laid out. Whether or not we've already had a recent election in Brazil, so we're not expecting another one in the near future. So it's probably more challenging there for the government to change tack too much. Argentina, I would say, hopefully there is an election coming up, so we might then see a government come into place that appreciates some of these reforms. That said, you don't want to minimize the challenges. If you look at India, also had a recent election with a lot of words being spoken that were encouraging foreign investors, but the implementation of that has lagged. And so we don't want to get ahead of ourselves. Even if you do get a more pro-reform government in Argentina, it's not like from one day to the next everything is going to change.